Growth stocks had their run, and now value is stepping back into the spotlight. And value stocks, if you didn't get the memo, have been outperforming quietly over the past 3 months, 6 months, and year. So which value ETFs offer a compelling choice? Well, today's ETF battle is an audience-requested matchup that's going to answer that question. It's a triple header value ETF matchup between Avantis, BlackRock, and Vanguard. Stick around. Welcome to ETF Battles. I'm Ron DeLegge. It's great to have you with us. This is the place we congregate to analyze and judge ETFs. So keep your excellent battle requests coming. Send me your ETF ticker symbols in the comment section below. You can also join our community by hitting the subscribe button. Just a reminder, too, to jumpstart your financial future with a smarter, safer, and robust strategy. Check out the free online classes offered by ETF Guide, whether you're looking to enhance your trading skills, improve the safety of your portfolio, or maybe planning for retirement. We've got you covered. All courses are available totally free to all of our viewers. Just hit the enrollment link in the description section below. So today's ETF contest was requested by a viewer named Nate, and it's a triple header between U.S. value ETFs from Avantis, BlackRock, and Vanguard. Thank you so much, Nate, for this excellent suggestion. Of course, value ETFs have been on the rebound and performing quite strongly. So let's tap into the analytical prowess of two of the best in the business. We've got Erik Ogard at BufferLABS and Mike Akins at ETF Action. Erik and Mike, welcome to the show.
Thank you.
It's great to be here, Ron.
And of course, a warm welcome to Erik. It's his first time on ETF Battles as a judge, so we're so glad to add you to our excellent roster, Erik.
It's a pleasure to be here, Ron. I'm looking forward to this.
So we got our 4 battle categories: cost, exposure strategy, performance, and then mystery. For mystery, that's where our judges can choose any factor or criterion that they feel is crucial to today's contest. Our judges can also nominate wildcard ETFs if they feel there's better choices elsewhere, or they can opt for split decisions. Keep in mind, none of the battles that we ever do on this program are ever predetermined or known in advance by myself or our judges. So let's kick things off with the first category, which is cost. We'll start with you, Erik. How do these ETFs compare?
Well, it's an interesting one because there are the obvious costs, just what it costs in terms of fund expense. But then there are things like implementation costs and the opportunity costs associated with any implementation slippage. So on just the expense ratios themselves, we have a couple of index funds here, and then we have the Avantis fund, which has a higher fee. But, just on fees alone, I think you have to look at what's the potential excess return of the strategy you're looking at. In the case of the 2 index funds, it's hard to make a case that there's much there. In the case of Avantis, there's a meaningful case to be made for an excess return.
So which one of these stands out from your perspective?
Yeah, it's interesting. The 2 index funds are obviously low cost. And if you don't believe in any form of active management, you just pick one of those and you're probably fine. My philosophy is listen to the active management case. I kind of like the idea of starting with a prior belief that if the active management case isn't compelling, you just go with an index and move on. But in this case, I happen to have spent some time speaking to the investment team at Avantis. I know them. I know their history. I know the firm they came from, Dimensional Funds. And I think, I like their form of active management in U.S. large cap value.
Thank you, Erik, for your analysis. Mike, you're up next. How do you see it when it comes to cost?
Yeah, you got a Vanguard fund, so my saying there, going up against expenses of the Vanguards is like taking a knife to a gunfight. But other than that, Erik makes great points. That all 3 of these funds are extremely well priced, right? The 2 index funds are basically free. The Avantis fund is 15 basis points for a quantitative overlay. So from that perspective, it's extremely cheap. It's going to have less overlap. So if you think about what you're paying for in terms of how different you are from the index, Avantis, from a risk budgeting perspective could actually be deemed a little bit cheaper because you're getting a little bit more of a tilt away from the index. But from a pure cost liquidity perspective, they're cheap. They trade like water. it shouldn't be a deciding factor between these three strategies. So I think we can move on to what might be.
Thank you very much, Mike. Strong start. So that takes us to exposure strategy. This is where we get into the details of what these funds do. So, Mike, you're still up. Break it down for us.
You've got two index funds, but they are different index funds, right? So I always like to think about overlap when you're looking at these strategies. So the iShares product, the Vanguard product, they're both index products. They're market cap weighted, but they have a selection methodology to kind of lean into the more value-oriented companies. That shows up in their exposure. All of these funds trade cheaper than the benchmark. But if you look at like IUSV and VTV versus the Russell 1000 value, you've got about 70% overlap. So very little tracking error between what they're doing and a broad-based, well-recognized index in the Russell 1000 value. That gets much lower when you look into the Avantis product, right? So Avantis is a quant shop. They're doing their factor overlays to these strategies, and it does, when you look through to the underlying holdings, result in a material shift away from the benchmark, right? So only about 30% overlap to the Russell 1000. To that end, they all have the value characteristics. There's not huge differences in sector or allocations. So it really comes down to, what are you looking for in terms of ownership? And I think because, within the value space specifically, an interesting stat, right, is if you look at large cap growth with overlap to the broad benchmarks, there's a high overlap because the growth names are the Meg 7s, right? So S&P 500 has a ton of Meg 7 exposure. Your growth has a ton of exposure there, so they're similar. Value doesn't have quite the concentration. Doesn't have those huge mega cap tech names in there. So when you're weighting these things by market capitalization, value tends to be much more diversified. And as a result, tends to have a little bit more divergence in return across these different types, whether it be passive, factor-based, active management. And to that end, one of the things I like about the Avantis portfolio, that really one of the few places you can see differences is kind of in the quality of the portfolio. Avantis strategy has a much higher quality score. And I think that matters when you think about value in terms of, especially as we know, like the Russell 2000 has a lot of zombie companies with negative earnings over the last 12 months. I think you can see a lot of that in value names as well. So I like that factor overlay, that quant overlay that Avantis is providing to get that higher quality score. So I'm going to go with the Avantis strategy for exposure strategy for that reason, though I will say I would expect them all to track pretty closely with winners, backing off, a little bit here and there, but yep.
And that takes us next to Erik. Erik, break it down for us. How do you see it between these three ETFs?
Yeah, I think, again, we're talking about the things that make these differentiated. And I kind of think, it's the tracking error risk relative to the benchmark. And so both of the index funds have a very narrow tracking error, and you actually pick up some meaningfully large tracking error with the Avantis product. And that's because they're emphasizing factors. So I like it too. And I like it because they are emphasizing factors that are time proven. Now, with all these things, you have to have some patience, but this is what I think. I think when value starts to come into favor again, and as you pointed out, it has, when you're loaded on the factors that they're loaded on in the value space, when it comes into favor, you're going to get some meaningful lift from that Avantis portfolio relative to an index fund. The other thing I point out is you've got pretty high turnover in the iShares product with 31% turnover ratio compared to 9% in the Vanguard and only 5% turnover in the Avantis product. So I kind of like the idea that you're loaded on factors, but they're pretty slow twitch factors. They don't have to move this thing a lot to continue to have the exposures they want.
Great points, and that shows us a high level of discipline, and that also not all index funds are necessarily low turnover strategies. Great points, Erik. And you alluded to it, Erik, about getting a lift. And that takes us to our next category, which is performance. So let's analyze how these ETFs have done. And of course, the past is the past. We also have to think about this what may happen in the future. So give us your analysis on performance. How did these three ETFs compare, Erik?
Well, what we see here is in, say, the last 3 months or so, Avantis breaking out pretty meaningfully to the upside as this value move has gotten momentum. And so, it's very hard to know if we're in a sustained secular move here. It seems like we might be. And if we are, that strategy looks poised to continue to dominate, to kind of reward that firm after launching and being very patient as value, as you pointed out, really lagged the growth markets. And so I think this feels like somewhat of an inflection point for me. I really like that fund long term on the performance. It's been good, and I think it's going to continue to be good.
Mike, how do you see it when it comes to performance?
Yeah, I mean, there's no question. If you look at the common inception time periods, Avantis is the top performer across all the time frames. A lot of that, as Erik astutely pointed out, is more recent outperformance. But I think, one of the things you have to keep in mind here with respect to these strategies is the iShares and the Vanguard do have a significantly higher tilt to large cap than the Avantis, which I would consider more of an all cap strategy. I think it's got 30% mid, 12% small. So it's had a couple of tailwinds recently. Not only has value started to perform relative to the broad market, relative to growth, but also we've seen small cap scream. So that's positive and negative. But I think to that extent, there's no question in my mind. I always talk about, do you spend your budget on, where do you spend your budget in terms of active versus passive? I think value has more opportunity sets for active, and I like to refer to Avantis or dimensional more kind of as quant shops because they have so many securities. But that factor loading and being able to screen across multiple factors matters, I think, more in the value space than it does with large cap growth or even just large cap broad. So to that end, historical performance is a no-brainer right now. The numbers are the numbers, and that's Avantis. But on a look-forward basis, I do think over full market cycles that their type of overlay with the factors to the value space can add alpha over full market cycles. So I like it on a go-forward basis as well. So my winner is AVLV.
I'd like to add one comment, and that is, the FAMA and French factors, small cap, value, momentum. Those things have been, they were sort of well documented when FAMA and French published their paper. And then, they kind of like vanished for 25 years. And if you believe that there's power in those factors long term, this is basically an argument of mean reversion back to outperformance of the factors after a very long period of underperformance. And so I kind of like it for those reasons as well.
There's been one factor, and I'm getting ahead of myself, but there's been one factor that has mattered the last decade, and that is size. And if you didn't have size in your portfolio, you underperformed.
Excellent points. That takes us next to the mystery battle category. This is where our judges give us that certain factor or thing that they feel is crucial to today's contest. Mike, you're up. What is your mystery battle category, and which of these ETFs stands out?
Yeah, so I think I just alluded to it, right? If you think about factors, there's the size factor, there's the value factor, there's the momentum factor, there's a quality factor. You can go through factors all day long, who you use, who you don't. But one of the things that has been absolutely disastrous for any factor strategy that's not pure market cap weighted over the last 10, 15 years has been if you didn't own the largest companies in the major indexes, you didn't keep up. You didn't own them in the same percentage. And I think that is something that we've seen unwind a little bit. I'm not calling for an end to the Mag 7 by any means. I think they're still fundamentally sound, but I do think we can have a reversion. And to that end, factors may start mattering again, right? If you take out and you look beyond the major cap indexes and you look at small cap or mid cap, or if you look at international, active and factors have done quite well. They haven't in the US large cap space. And I think we're starting to see a little change there. So my mystery factor is that size component. And I like the fact that Avantis is a total market strategy in terms of the way they're kind of weighting the portfolio. So to that end, my mystery winner is also the AVLV product.
Thank you. Erik, you're up next. What is your mystery beta category? Which of these ETFs wins it?
My mystery factor is the information ratio. And that's just a way of saying, look, we've talked about returns, but it's the amount of return you're getting per unit of risk in these strategies. And so to me, it's real clear when you look at it through that lens, one of them is out for sure. And surprisingly, that's the iShares product. They're so close to benchmark. And when you compare what Vanguard has done in information ratio space, they have significantly less risk on the risk side, and they have an improved return over that risk. So between the two passive strategies, Vanguard's the clear winner. And then if you ask yourself, what's the information ratio look like for the Avantis? That's a way of saying, does the extra risk they are introducing into the portfolio mix pay for itself? Are you getting paid for that risk? I believe the answer is yes, and will continue to be yes. And so for that reason, I say go active and go Avantis.
All right. Well, we're going to give our judges one final chance to give us their overall winner. Erik, you're up. Give it to us.
It's Avantis for me, loud and clear.
Thank you very much. Mike, your final chance to weigh in with your overall winner.
Yeah, I don't think we're talking about strategies that are what one might refer to as blow up strategies in this battle. So I don't think you can go wrong with any of these strategies. You either believe in a little bit of active or you don't. I would not consider Avantis to be full throttle active. Like I said, I keep saying quant. It does own a whole lot of securities. It does keep a relatively tight tracking error to the broad benchmarks. But I like the way they do it. And I think that they can add value over time. And I think that exists in a lot of areas of the market that aren't large cap growth. I'm sticking with AVLV as my winner. And yeah, take it to the bank.
All right. Well, our judges have spoken. And according to our final battle scorecard, today's winner is AVLV from Avantis. And our judges agreed in most categories. I mean, it was pretty much across the board with none of the passive index ETFs really getting much votes in terms of a favor here. And our judges make their arguments quite clear. I think one of the things that Mike alluded to when he talked about size, which I thought was pretty important, is that all cap strategy. So, there's been this dominance over the past several years of large companies in the market. And so here's a way to balance that out with some smaller companies, which may offer some good upside potential. And so that was a great point. And then, of course, Erik making his point, pretty much agreeing that he likes AVLV's strategy with that quant approach. We might call it maybe quasi-active, because it's not like full-blown active, but still rules-based and very disciplined. Great job to both of our judges for breaking down today's ETF matchup. And to Nate, our viewer who recommended it, great job to both of you guys. Thanks for joining us.
Thank you very much.
Thank you.
And be sure to hit the description section below. We've got links to both of our judges, so get in touch. Also, which ETF battle would you like to see on our next episode? Hit me up with your ETF ticker symbols in the comment section below. I'm Ron DeLegge with ETF Guide. Thanks for watching. We'll see you on the next battle.